You can get the market average just by buying a low-cost ETF and not putting your money into ILP, for example, or a product that is sold in a private bank. They obviously want to push structured products, a lot of things that make them money and don't necessarily make clients money. So there's actually no correlation to how well off you are to how good you are at investing. It doesn't matter because there are so many people with so much money who have no idea what they're doing with investing. And there are so many people who don't have a lot of money who are just doing the basic thing and doing well, buying an ETF and doing really well at it. I've never understood it, but a lot of people in the US and I guess worldwide like a lot of young investors are actually interested in these dividend ETFs, even though your capital is getting torched, but you're still getting, I don't know, like a 15% yield.
What are structured products? Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut. And today we are back in studio with a friend of the show. And I've known him for quite a while. I've seen you around, right?
Yeah.
And the interesting thing is I think his investment ideas have changed.
Yes, over
time, right? And as with many people that I've had on the show, I love to talk to people that have shifted their ideas, right? Because that's a sign of growing up, right? That's a sign of you maturing and changing your perspectives depending on different phases of life. And I think it's a great discussion to have, right? For people to learn. But more than that, recently he's gotten quite viral on the internet, right?
I wouldn't say viral. Maybe just a bit more popular.
Yeah, quite a bit more popular. He was popping up the TikTok, and I was like, what is this guy doing on TikTok? All right. Because when I knew him, he was a writer, right? He wrote, and then I was like, writers don't usually do TikTok. They suck at it.
Yeah, I've got to diversify, right? Yeah. Just like when you invest.
Exactly. So very glad to be in studio with Tim. For our audience that don't know you, could you introduce yourself?
Yeah, so I'm Tim from TimTalksMoney. So I've been out there on a mission to educate investors, and I also run a financial writing agency called Income. So I help financial services firms really communicate their messaging to clients and to the investing public in a more relatable manner.
Oh my God. Yeah. So you're their sales agent.
Well, not really. No, I'm sort of a writer. I would say sales agent.
You're like their tool in trying to convincing people to buy the stuff, right?
I would say I'm a sales writer. I'm not a sales writer. Okay. It's more like thought pieces, analysis, that kind of thing. Yeah.
We'll get there. He has a lot to say about the industry and, some things up the alley. So we'll go there, right? So I've asked him on the show primarily to understand how his personal finance journey has been, his investment ideology, how has it kind of evolved. And of course, he's doing all these videos online telling you, use this thing, use that thing. And I was like, I want to get one good one, right? Like an honest one. After evaluating so many things.
But when I do something, then someone is like, oh, but how about this one? Or how about that one? I'm like, oh, okay, I should probably do something about that as well.
So maybe for a start, go beyond your handle, go beyond what people can find on your internet.
Yeah.
Like what got you here? Like what got you into this personal finance thing and that whole like download?
I actually I wasn't from a finance background for schooling. So, I did a history degree for university and I was originally a writer, but I've always been interested in investing since my dad introduced it to me in my teens. So I've always had an interest in it, but I haven't had some solid background in economics or finance or maths, or physics, like a lot of people might think you need to be good at investing or interested in investing.
Who knew he's a history major?
Yeah. So history, not the most exciting for a lot of people. And then I moved into initially copywriting on the ad agency side. And then I moved into actually as an investment writer on the asset management side. And then I moved towards the Motley Fools. And then I went to CGS International and I helped set up the Prosperous service and tried to educate investors about, how to invest into stocks, into equities. And from there, I was also involved in the private wealth segment of CGS just before I left and started my own thing, my own business.
So what made you leave the sector?
Mainly it was to do with the fact that I wasn't really enjoying that job and I wasn't really feeling as though I was making an impact on clients. And I think that is a problem, I guess, throughout the industry for a lot of the wealth segment, I would say, is you're helping more high net worth individuals, people who are obviously already wealthy, try to grow their money, but it's much more product driven than it is really focused on aligning client interests with firm interests, right? But I don't think that's anything specific to the place I worked. I think that's something that's endemic
industry-wide,
industry-wide, right? I enjoyed actually trying to help people invest better or think about investing in a smarter way. And I decided from the start with the socials and my profile that I wanted thinking about allocation to equities or allocation to your bonds or allocation to gold, or for example. And then also just trying to educate investors on what are the best routes to go do that if you wanted to do that. And I think making investing simple for just the everyday person who maybe doesn't have time to research stocks, doesn't want to research stocks, doesn't maybe want to hold lots of different individual companies, is too busy with life.
But then when I first got to know you, you were single stock, you know,
Yeah,
you're writing
yeah.
all these things,
Yeah.
and talking about all of them.
Yeah.
So like where are you now, right? Because it could be like an online persona, you know, we do the mass, you know, because I mean that's the content business, right? I kind of understand how this thing works, right? So you could be like online or broadly diversified, you know, and then deep down, right, it's like I only hold 5 stocks. You know, these are my 5.
These are the 5. I'm going all in. No. I think for me it was more, I'm getting older. You're thinking less about growth stocks and the crazy type of hyper growth stocks that you're thinking like in the AI space, and thinking, okay, how can I get access to that through broad market exposure, whether that's like, I don't know, a thematic ETF or a NASDAQ ETF, right? Which you can still get exposure to growth and not take that massive single stock risk. So it's maybe part of the evolution, right? I'm thinking, okay, I still have a small number of like growth stocks, but then I have a decent number of dividend stocks. And then, you know, I'm shifting more of that capital towards broad market ETFs in total, because I think for me, it's thinking about the average that you want, right? Whether that's 10% global equities, that gives you the annualized return 10% over time, versus, you know, you could find the next NVIDIA, but the next NVIDIA could turn into, I don't know, whatever, the pets.com or the whatever, you know, the bubble that burst. And so it's how long do you ride that? And then finding the time to get in, to get out. So there are so many calls that are necessary on an individual stock recommendation. And I think for a lot of people, maybe when they go into a stock or they hear a stock rec, right? They're like, okay, this is great, I've bought it. And then it goes up maybe like 30%, and then they sell out. And then they might think, oh, I should move on to the next idea. So it's almost like you're churning ideas if you have that mentality. And there are some investors that obviously have the capability and the discipline to hold on for really long stretches where it just keeps compounding. But a lot of people have there's a lot of psychological barriers to keeping that position, and then also understanding, when do I trim it? When do I add to it? How big is it going to get as a part of my portfolio? And so there are so many questions that are not answered in that realm of the investing journey, I think, on the individual stock side. Whereas the allocation side is pretty straightforward, right? You have equities, you have bonds. When do you rebalance? 60-40 if you want to. I mean, I'm not a conservative investor, so I'm pretty much, I'm pretty much 90, 100% equities, right? But it's easy to rebalance that. Whereas with stocks, you're like, oh, some people have different rules about how much they're willing to have in one single stock, right? I mean, for me, it would probably be like 8%. But from some people, they're like, oh, I'm happy to have like 20% or 25% in one stock, right?
One with 5 stocks.
Yeah, 5 stocks.
The 5-stock guy. So put in the comment section.
Yeah. Who are you?
Which are your 5 stocks?
Yeah, which are your top 5? So I think that's kind of how it's panned out for me. And I've seen it happen. And in the financial industry, there's just a lot of selling on specific names, maybe in structured products or something else, which has nothing to do with really growing your wealth. And that burns a lot of people, right? So I think for me, it was more trying to help people align with how I was evolving as well. So I think for the person on the street, the average person, maybe not your audience here actually, because your audience here is just more like finance, finance focused, right? But for the average, finance, right? So they're really interested in individual stocks. So I totally get that. But I think for the average person who just wants to try and build their wealth without torching capital or without chasing, hot stocks and trying to control their emotions, I think the ETF route is the best low cost, efficient way to do that, right? It's the best way to grow wealth over a proven time, because you've had 120 years of data through however many world wars and Cuban Missile Crisis.com, great global financial crisis, all these crashes, and you've still seen the markets do well. And so I think it's more about the emotional side of investing for me, and trying to relay that to people, that you can get the market average just by buying a low cost ETF and not putting your money into, I don't know, ILP, for example, or a product that is sold in a private bank. They obviously want to push structured products, a lot of things that make them money and don't necessarily make clients money. And I think I'd seen a podcast on LinkedIn recently where some guy had started his own asset management firm after like 20 years. And he had this great quote. It's like, I've never heard a client ask for a structured product, right? Yeah. So it's like the structured product is always sold to the client. It's not like the client's like, hey, I want a structured product of this because like, and as though they know maybe what they're buying. But I've seen a lot of people with a lot of money burn a lot of money or torch a lot of money being silly on kind of stupid products. It's interesting because people may think, oh, investing, you can only do it if you're rich or you have a lot of money. But that's totally the wrong approach. I mean, I've always said this, but the amount of money you have has no correlation to how good you are at investing. There's loads of people out there just investing in a basic ETF and they'll be absolutely crushing someone who has got maybe like $20 million because then maybe that person who's got $20 million has just been buying structured products or just buying garbage. So there's actually no correlation to how well off you are to how good you are at investing. It doesn't matter because there are so many people with so much money who have no idea what they're doing with investing. And there are so many people who don't have a lot of money who are just doing the basic thing and doing well, I would assume, right? You know, buying an ETF and doing really well at it. So I kind of want to dispel that myth as well.
Okay, fair. Just based on that thing, I got a lot of questions to ask, right? Because there are a lot of assumptions in those things. But maybe let's just start with the structured product is garbage. You know, this thing, like why do you think structured products are garbage? Like maybe just kind of walk us through, right? Like, and to be fair, I don't think most people would get access to structured products, you know. But you never know because there are a lot of so-called private products in the past that because of marketplaces have become more democratized, right? Essentially means you get access to all these other products. I'm not saying whether they're good or bad, but it's just because of certain systems. It has like the marketplaces, like apps, like, you know, all these things made it easier for these products to be pushed to use. So you never know. It may end up with you. But you know, tell me why is structured products garbage, and like what are structured products from your look?
Well, my perspective is that they're just a punt. It's like a gamble on a certain stock hitting a certain level and you making, you know, X amount of money off it. I don't think it's actually an investing tool because when you talk about investing, it's investing into a company with cash flows over time, and you're not, say, betting on a specific outcome, right? And with structured products, it's just, there's so much money to be made from it on the financial services side that it makes no sense not to push it.
How does it usually look like one of these products? I mean, just kind of walk us through a little.
It would be like, you know, maybe Baba needs to hit a certain level, like a knock-in level, and then you'll be able to get a coupon. You get like a high coupon, right? But then if it goes below a certain level, you can get wiped out. So there was a lot of people getting wiped out during the China crash of, you know, a few years ago. And so I think it's much more about people being attracted to maybe a headline rate or a headline payoff, et cetera, et cetera. And it really doesn't benefit indulging people's worst emotional sort of vices, right? When you think, oh, I can get this or I can do that. And that's what I think these products do, is they just indulge that need for, oh, I'm going to get this quick gain. I'm going to be able to do this. So, you know, you have to be in specific things. You have to be in specific managers. So it's almost like in private markets, it's almost like stock picking, actually. You can't just buy a private market index like the S&P, which would just deliver you a return, right? You kind of have to pick managers. And for institutions like pension funds, endowments, it's different, I would say, to an individual, because pension funds, endowments have horizons of like 100 years, 150 years. You know, you want to spend your money at some point, right? So you need to plan for that. And you can't be saying, I'm going to get this X amount of return over however many years by investing in private markets, because the data isn't there to support it. So I never see a lot of data that supports a lot of these claims for products. And I'm surprisingly, for someone who did history, I'm quite data driven. I like to see data. You know, I kind of want to understand. I want to understand, oh, does this performance beat this performance of this product? And if it doesn't, tell me why, and why should I buy this product versus this, which is much lower cost. You don't make any money from it, but it's better performing. So it doesn't make any sense, you know, to me. But you see that a lot because obviously we have that incentive to do something different with our portfolio. There's always that pull to try something new, to generate alpha and think, okay, we're beating the market or we're doing better than someone who's not an AI or doesn't have access to this, right? And so, but I think that's the whole point. Like I think successful investing, a lot of it as I've grown is realizing you need to withhold or just tune out this noise. There's a lot of noise, right? In the product space, there's so much noise.
There is.
You basically just need to tune it out. And if you can tune it out and just focus on whether you're stock picking or whether you're doing individual ETFs, or ETFs, just continue to do what works for you. And even if it's boring, that's supposed to be the point of investing, I think.
Okay, fair. And before we go there, and just for the benefit of our audience, right? Because I don't know how you performed previously in your single stock days, right? But I do want to kind of put that out there that is there a situation that because you did well in your single stocks, and then you've kind of like grown your capital. It's a bit like Keith, right? From investment modes. He puts their whole portfolio up. I'm not sure if it's still there, but go to investmentmodes.com. He puts his whole portfolio there, and you see it change over time, right? Like when he first started, young, crazy, nothing else to do. Let's just like single stock, grow, and then you hit a critical mass. Then you kind of like convert. So like, would you think that that's still the way? Because what you're saying now, it's broadly diversified, right? Broadly diversified, broad-based ETFs, low cost, because that's like the mantra of the day, right? And the data does suggest, although there are some assumptions which we will go into later, right? But don't you think like the front part was very important also? Just to hear your point of view on this.
No, it was. I mean, I learned a lot as well, and I still have an interest in individual stocks, but I think it's more
but beyond learning, right?
Beyond
it's like the capital,
the capital appreciation, right? Of that, definitely. I mean, I think it's
so he
definitely
had his 5 stocks days,
I've grown beyond
not five, like 12, or 15, right?
No.
Usually, a lot of the single stock pickers are around there.
A lot of single stock. Actually, technically, you're supposed to have around 20 to 25 to be fully diversified, right? Well diversified with a single stock portfolio. But no, I think it's more like that was the engine that was good. That's helped me kind of grow my capital as well. But then I've moved towards the thought of maybe thinking that the core is really like 60, 70% of it now. And then the sort of the satellite, which is what I would say anyone could have. They could just take their thematic bets or they can have their single stocks if they want in that basket where it provides you with like extra income. But I also know there are some guys out there who do a lot of the dividend, basically just living off the dividends, right? Whether that's like REITs or banks and I think that works for some people and that's great. I think it's just for most people that would be for those who it does work for. It's people who are interested in stocks or interested in investing world and want to keep up with it. And a lot of people out there, for me, I think it doesn't. And so it doesn't resonate maybe with them. And so I don't try and put that out there, but I've also built a small dividend portfolio where I want to have passive income as well. And I take an active interest in the company. So that's me, but I'm in terms of my persona and what I'm trying to educate people on, I don't try to tend to do that unless it's more like a satellite position, right? Whereas you can build a little portfolio out there if you want it versus outside of the core allocation, whether it's equities and gold or bonds or whatever you have in the core allocation, that should be really the one that you let grow over time. So yeah, it's definitely been an evolution. I mean, the growth period was fun. It did help. And then it sort of changed as I evolved and sort of grew older as well, because you're thinking about, okay, things are moving, how things are shifting in the world, and then also how much time you have out of before you maybe want to plan to retire. When you're in your 20s, you hear this from a lot of investors, right? You should be making stupid mistakes in your 20s because you don't have a lot of capital to burn, but you can't be taking sort of like 50% positions in like growth stocks in your 40s, right? Because that's just not smart. So you do need
because the position much bigger now. And you're not living off position, you live off the capital.
Off the capital, just trim.
So the size is quite big. I said, must think properly.
Yeah, just go all in on Palantir. No, but it's more about the balance, I think, when you get to a certain age. And maybe some people are different, and I think that's fine. It's whatever balance you find in your own portfolio and whatever you're comfortable with, I think go for it. But I think for the majority of people, maybe outside your audience here, it's more about just trying to grow their capital base, capital wealth in an average 10% annualized position. Because if you can put that capital that you have in T-bills and SSBs yielding, I don't know, like 1-2%, right? And put it into long-term equities and you're not retiring in the next 10 or 15 years and you can hope to get maybe 8-9% on average, you're going to make a significant difference to your capital growth over that period, right? So I think it's more about understanding the market, but we all know about this. I mean, I guess your audience knows about this, right? The whole mantra of the data over 120 years suggesting it returns 8% a year, 9%. You just hold through drawdowns. It's all very normal things to people who are in the investing world. We know that. You hear it day in, day out. But I think for most people, the whole thought of crashes, it's more, I've got to sell and then buy back in and then sell, and then you end up selling low and buying high, and that just destroys your capital. So my message out there is more trying to help people think about investing from the psychological perspective by introducing lessons from history, which are more relatable, trying to break it down for people in terms of fees, like what fees you're paying for certain products, we might touch on in a bit, but that kind of thing. That kind
I'm getting there.
So I think it's more like the things that are in the background that aren't really talked about a lot. That's what I try and hope to bring to the attention of investors in Singapore.
Yeah. Okay. So I want to get there, but before I get there, I think you all know where we're going. But before I get there, I do want to hear a little bit on this, like, I mean, what I will call the hype ETFs, right?
Yeah.
Essentially, when there is a new hype, it could be, I don't know, solar. There was a period of time, right? There was solar, and then there was like cannabis, and then there was, I don't know, robotics, there was AI, there's everything. Always there's a theme. And then that's like a run up. Usually the market has already had a run up, right? And then you start to see these ETFs pop up. And I'll call them hype ETFs, right? So they ride a hype, and then there is like a product that comes out of it, right? And so what is your take on those?
I mean,
we're shitting on the whole industry. Oh my god, this is the end of TFC. No more sponsor. You better all do a Patreon. Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And we'll see you for great content on Chills with TFC.
No, the thematic space, I have actually spoken about this in the past. I mean, you're right. I totally agree. I think there's that run up, and then it's the peak when there's like 10 ETFs coming out, right? And then I've talked about thematics in the terms of what is a thematic? Is it a thing like AI? Is it clean energy, which is the traditional thematics? But then there are other subsector, maybe thematics that you might think also count as thematics, like single country or single sector, like healthcare, or I don't know, like India or Japan or China, right? That might be like a thematic. Some people might consider that thematic, but I think you're talking about the hype stuff, like the like cannabis,
the new hype
stuff. And like the AI and robotics thing, I just don't understand as well. I see a lot of these AI ETFs pop up and robotics ETFs, and they have pretty much all the same names as like the NASDAQ, right? So the NASDAQ gives you, I don't know, 9% exposure to NVIDIA, and maybe this, I don't know, ETF in AI gives you like 15% or 20% or whatever. And then there are some chips, but a lot of the stuff there's a lot of overlap between, I think, maybe a tech ETF anyway. So I don't really understand the appeal of it. And then if you think about also like cannabis, that was totally destroyed because of regulation. And so there are all these things that haven't done well. And actually there was an FT article maybe like 3 months ago that used Morningstar data to look at thematic ETFs and what have outperformed like since 2020. And there's only one sector that's outperformed the benchmark, and that's defense. Defense ETFs have done well, since 2020, but that's on a 5-year basis, right? But cannabis got destroyed, like, health sciences got destroyed. There's a lot of other things that got crushed as well. And, AI, I think, was pretty much on par with the benchmark of 1% in terms of excess alpha, right? So it's almost like you should have just bought a tech ETF, like a basic broad market tech ETF, instead of an AI robotics ETF, right?
So I agree. Sponsor calls. There's no more. Nobody's gonna call us anymore.
No, I mean, I'm trying to be candid, trying to be open, but
I love it. Yeah. And these ETFs tend to cost a lot more.
They do.
Right?
They do.
Than like the broad base,
because they're
the
actively managed. I mean, obviously, it's a reason to launch it. It's a reason to to put it out there. And some of these other ones like covered call ETFs, you know, the ULTYs, all these Ultramax, like, and you get your capital destroyed. I've never understood it, but a lot of people in the US and I guess worldwide like these, like a lot of young investors are actually interested in these dividend ETFs, even though your capital is getting torched, but you're still getting, I don't know, like a 15% yield or something. So it's just shifting it to a different place, right? I mean, it's not really doing anything in terms of growing like your wealth or being able to tap like actual cash flows. So yeah, thematic ETFs, I'm not a huge fan of. Single country, single sector, it's a bit different. I have different opinions on that from what other people might think as well. So, but yeah, on the thematic side, there's a lot of hype, right? There's a lot of hype and there's not much staying power in a lot of these things. They kind of have their high and then they kind of dip and they fizzle and people don't really remember them.
Yeah. I mean, you just got to be around long enough to know that that's the truth. Right? The fact that we're talking like that, you know, we've been around. Very sad, but yeah. Okay, now we move to the juggernaut, right? Of fees, right?
Fees.
Essentially, this is you brought it up, which is the ILPs, right?
Yeah.
So now I think it's getting a little bit of a discussion again. I don't know why. I don't know where did this thing come from. You know, I thought the debate was settled. You know, ILP was a product of the past. You know, it worked great previously. You know, because it was very hard to even get a call on the brokers. You know, if you don't have truckloads of money, nobody's gonna entertain you. So there was a period of time that, you know, it kind of worked. But then I think, you know, I thought the debate was done. You know, there are new products. You know, like new updated structures. Those things. You know, although I gotta give it that a lot of ILPs have adjusted their cost structures also, right? Because they know that they can no longer charge. Yeah, they got competition. They can no longer charge like the past. So they've adjusted the cost. But you know, you compare apple to apples, it is still not as good as a lot of the
low cost.
You know, low cost. You know, all that. So I thought the debate was done.
Was settled, right?
I thought it was settled.
Yeah.
I don't know where did this thing come from, and we are back at it, right? Like this is again. So I don't know. Maybe you guys can educate me. There's something new. You know, some changes. I don't know. You know, because from how I looked at it, nothing has changed, right? So like, what is your take on this ILP?
Okay, so first off, let's establish that I think everybody in the financial advisory industry who's not driven by commission will admit that they are not a product that you should have in your portfolio versus term insurance and low cost ETF investing or low cost investing.
Invest the rest.
Buy term, and I think that's pretty much the consensus, right? For people who have no vested interest in whether to buy an ILP or not buy an ILP, right? I think that's pretty much the consensus. I would hope, and the data suggests that, right? I mean, we look at a lot of the data from low cost investing and your term insurance in terms of, you know, what is the burden in terms of your premium, et cetera, and then you have all these additional costs and then, you know, surrender charges and fees and you just do the math and do the data, work the data out, and it's all basic maths. So look at what you can expect to get from a global equity ETF, which is like maybe over the long term, let's be conservative, say 8%, right? And how much would a low cost ETF charge? Like 20 basis points maybe, right? So you just say, okay, maybe I'll get 7.8%, right? Put that into a compound interest calculator over 10 years. You know, how much would you get from $10,000 starting? You get just over like $21,000, okay? And if you put that into a ILP and did the same with $10,000, but you've got fees of maybe, I'd say be conservative. I'm not going to say like 2.5, 3%. Be conservative, say 2% per year, right? 10 times a low cost investing plan, a low cost ETF, you're going to have 15% less after 10 years. So you're going to have around like 17,900. All right. And so if you expand that out and the whole compounding thing, right? Everyone's like, oh, compounding your wealth, which is so true, compounding your wealth. But no one talks about fees. Fees also compound. So they compound as well along with your wealth. So fees are going to get eaten, are going to eat your wealth, right? So as you get bigger, your pot gets bigger, your fees are going to get bigger. So it's important to keep fees as small as you can keep them. And so if you do that to 20 years, you compare the two, you're going to have 29% less in an ILP that charges 2% versus the low cost option, 29% less. So it's compounding in terms of the capital you're losing or capital you're giving up, right? And this is like what we talked about just before the show, right? I was saying it's wealth destruction by stealth because you don't realize they're not taking it out of your CPF. They're not taking it out of your bank account directly. They're not saying, here is a bill, pay me the fees now and with your card or transfer it to me. They're taking it out of your units. They're taking it out of your wealth. So you don't realize it. And so I think a lot of people don't realize that that is how it's taken from them. And that's just a big problem that I see in the industry is if you don't change the incentive, the outcome will not change. And so that's, at the end of the day, that's the problem. People maybe don't dwell on that so much, but that takes a lot more big level changes, right? And also how many people in Singapore, Hong Kong, et cetera, work in the financial services industry, make a living from selling ILPs, et cetera, a sizable amount. So those are things to consider probably at like the, the government regulatory level. And I don't have a solution to that, but I think that's obviously a key reason why it persists, right? Or why there's that issue. So you've got a double whammy of high fees in ILPs and most likely underperformance on the fund side, right? Whatever you're picking is probably going to underperform a basic benchmark. And then the insurance side, there's a lot of these ILP 101s, which just don't give you enough coverage in terms of like 101% payout or whatever it is of your coverage. That's not enough, right? I mean, if you have insurance or term life, you're supposed to have like 9 to 10 times your annual income. That's the general benchmark of enough coverage.
I am of the view that I think financial advisory still has a space to play.
Yeah, it definitely does.
But you can always do other products, right?
But the incentive needs to change, right? Yeah.
Some products are really just not that great, And as more and more buyers, like buyer beware, right? Like more and more buyers kind of understand this thing.
Definitely.
Then you hope that better products will prevail, right?
Yeah.
And things that are not so good, maybe it was good in the past, not so good anymore. Let's move on, right?
Yeah.
So I think that's the thing, lah, right? So yeah, it is what it is. I know you're on your chair, hold your horses. You can attack Tim in the comment section.
But the funny thing is, whenever there have been some people that have approached, online and said like, oh, this and that, who have been obviously pro ILP, but I'm like, show me the data, right? I mean, I am a data-driven person. I like to see the data. Show me the performance data that this ILP, which is very widespread, it's like consistently beaten a low-cost index ETF over time. But I'm like, where's the numbers? Where are the numbers? Because at the end of the day, your wealth is based on percentage growth. I mean, it's maths, right? So if you can't grow your capital X% per year, you're not making a particular amount of money. So there's a lot of talk out there, but it's all narrative driven from the ILP side. So I would love to see some data that says, okay, this can beat like the MSCI All Country World Index ETF, which charges 20 basis points, and your ILP with all these different funds can beat it, on a regular basis, net of fees, after fees, right? After fees. That's what we're saying. So beat it after fees, not before fees, after fees. But also, actually, there's a cut. I had an interesting analogy. Well, I've used the analogy before, but it's kind of funny because financial services, it's almost like you have fees there, right? But it works in like the reverse to how it would in any other realm of life. So if you have high fees, like maybe you're going on SQ, Singapore Airlines, right? Everyone loves Singapore Airlines. You're going on first class. You're paying, I don't know, maybe $20,000, $30,000 to go to London, but you get like an economy meal and then you get stuck in economy. Is that a good experience is that value for money, right? And that's exactly the analogy I use, because you use like a low-cost ETF. It's almost like economy pricing. You pay for economy. So I'm paying like, I don't know, $300, but I get to sit in like suites in Singapore Airlines. And that's the performance I get, over time. So I try to use that as an analogy because a lot of times we don't really think about fees, what we're paying, right? And so it's like, it's your value versus like your experience. And the fact of the matter is that ILPs are like first class pricing, but economy type of experience, right? So it's more, I want to switch that narrative and flip that narrative to be like, you should be paying sort of economy pricing and getting like first class experience on the investing side. And that's what you should be getting.
Let's move into, like your realm, right? It's essentially this low cost index funds, as or like broadly diversified funds. There are also assumptions in this
of course,
investment methodology, right?
For sure.
And I think one of the biggest underpinning of this whole thing is the dominance of the US dollar.
Yeah.
Right.
For
So
sure.
and it was a little bit of a discussion on the internet, but I think people were just too much storytelling back then. But now I think amongst the financial professionals, people are taking this thing seriously. You know, I hear more chats, you know, like Moody's had a downgrade, SGD has a fund inflow, DBS just announced that, you know, it's going to be 1-to-1, $1 to one Sing dollar in 2040. I mean, that's what they predict. And I think that this also brings into the aspect of like CPF versus EPF, right? Because one of the previous episode, one of the comments below was like, oh, but you know, EPF pays 6%. Honestly, if I'm doing EPF, I hold in Sing dollar, I convert back, I already make that the kind of percentage, right? So and this is important because a lot of assumptions in this broadly diversified investments is all pinned on the US dollar. Right. So if I am gonna make 8 to 9%, you know, per year on US dollar, but because I live in Singapore and I spend in Sing dollar, I'm experiencing a 10% depreciation this year. I actually I lost. So I lost 1% my investment. That's true. Right? So like, you know, what is your take on you know, some of these things, and you know, any thoughts on what DBS said, and you know, how are you kind of like then, you know, maneuvering your portfolio in this so-called like new landscape?
No, definitely. I mean, that's totally a valid point. I mean, and just in terms of the data, I think the US dollar had its worst like first 6 months since like 1980 or something. Since the 1970s. So like nearly 50 years. So it's had like a really bad sort of run year to date. And I mean, there's all the reasons behind that, right? Trump, like fractured trade, et cetera, et cetera. So don't want to dive into that. But in terms of your actual allocation or how I thought about it is that a lot of it now is, I mean, that's one reason why Singapore's probably done really well this year. Right? Year to date, Straits Times Index like hitting a year to date high. It's solid. It's a solid. And I got a question, I think like a few weeks ago at SGX about, what are the alternatives to the US dollar, right? You know, and then people might be like, investing in euros or Swiss francs. But actually the Singapore dollar is one of the best performing. Actually, over the past 10, 20, 30 years, there's only two currencies that have positive returns against a dollar, and that's the Singapore dollar and the Swiss franc. So only two currencies out of like the major currencies in the world have posted positive returns on all three timeframes, right? 10, 20, 30. It's pretty amazing. You've seen a couple of results of that, including people are more interested in the Singapore stock market or Singapore dollar denominated. Banks are doing well. REITs are starting to get more interest since rates are falling. And, you know, we've had that support package on the MAS, et cetera, et cetera. So small and mid caps are doing better. So I think one route for some people is that they're probably allocating maybe more to Singapore and outside of maybe US dollar ETFs. Another route's obviously gold. People are more interested in gold, and gold's, you know, done whatever this has done this year, 50%. So some people, you know, I would say 2020, I was always of the thought that, hey, gold, like what's the point, right? Doesn't produce any asset. That's a single stock guy. As a single stock,
mantra, right? Because the Buffett
But I think I'm not dogmatic in the sense that I refuse to change how I think, right? So I mean, you have to be flexible as an investor. And that's not to say that I'm, you know, like holding 50% gold now or something silly, but, you know, an allocation that traditional advisors or the traditional fund management industry suggests is like between 5 to 10%, right? And I think that for me personally, that seems sensible, but I can understand why some people don't even hold it at all, which is fine. It's totally fine if you don't. But that's another route that a lot of people have taken is even if you buy it in US dollars or Sing dollars, it doesn't actually matter because gold's priced, you know, it doesn't really make a difference on the currency side. What currency it's priced in, gold will move to its own like beat. So gold's become more popular because it's not in control of President Trump and no one can control it. No one can put sanctions on it, et cetera. So that's been one route that you've seen. And I see a lot of people also talk about, I think I'd seen something from like Chris Tan at Providend, like maybe, I don't know, a few months ago talking about CPF, and a lot of people that he works with, CPF they don't use it to invest. So I think a lot of Singaporeans actually might even use CPF as their bond allocation, right? They just keep all their CPF there as you're getting the 2.5% or 4% or whatever it is. And then you get your RA, and then you get your CPF life when you hit like 65, et cetera. So maybe a lot of people don't, and I would think, oh yeah, CPF maybe is worth like investing, but then you hear him and it's, it makes sense, right? A lot of people have thought maybe they've shifted their mindset to thinking about CPF as just a bond allocation, right? For their own personal portfolio. And so I think there's lots of different avenues that have popped up given the US dollar, I guess, fall. But I mean, on the other hand, when you do invest, you don't also want to make currency calls. So I think there is that temptation to be like, oh, the currency, I'm making a call, because you're still making a call on the market in terms of the currency call. It's just more the US dollar. And in the past, there's always been talk about, oh, this is going to happen to the US, that's going to happen to the US. And it doesn't. But obviously, the fear factor is higher, and it always feels higher in the moment. So I think there are things that you can tweak on the side, but I'm not sure you go wholesale and be like, oh, I'm going to move everything into, I don't know, Singapore dollar sort of denominated assets that are hedged against US dollar. I think you just have to be a bit more mindful of it on the edges, and like maybe think about what you would do to mitigate that. But I would hesitate to make like a massive call on a portfolio based on like a currency.
So you've not done any major...
I mean, I've been adding a bit more gold like last year and then this year. I haven't added that much recently, actually, to be honest. But I have added some. And then, thinking about diversification, it's more like, I've added more to like my Singapore portfolio as well, because, Singapore dollar. So stuff that I think most people probably have done this year anyway.
Okay, great. That's a good discussion.
That was fine. I hope we don't get too much. I hope we don't get too much hate in the comments.
I tell you all, okay. we may end up in a Patreon situation, right? Like you gotta keep the lights on for TFC. No more sponsors, right? But I do think, even though we do run this whole outfit on sponsor money, we are quite anchored with our audience. So I think I think those are all valid, very valid points. Not that there are no other school of thoughts, but we always welcome a healthy debate, right?
I love a healthy debate.
So
I love to
let's organize something. I will do something on this front. So
should.
Thank you,
Reggie.
Appreciate all the candor. I hope you get cancelled.
Thanks. I hope your audience finds it useful, or at least a bit more informative.
I'm sure. So if our audience would somehow have not seen your TikTok, would like to connect with you, where's a good place?
Please do. Connect with me at TimTalksMoney SG on TikTok and Instagram, and you can also subscribe to my YouTube at TimTalksMoney.
Okay, great.
So please do give me a follow.
Good. Welcome to YouTube. Right?
Thank you.
So thank you. I hope you enjoyed today's episode. And if you love what we do, head over to thefinancialcoconut.com to put your email address, so that when we have an update, we have many events lined up, and I am preparing a lot of good stuff for next year also. So with that, thank you. Thank you. Yeah, I'll see you next week, next episode of Choose with TFC. Meanwhile, take care. Bye-bye.
Cheers. Bye.